Yo, what's up, Bulldogs? All right, today we're going to be talking about where to invest your money. This is one of those topics that a lot of you guys have been asking me. A lot of my coaching clients have been asking me. I've been trying to figure out actually myself too in what's going on. So I've brought in Chris Odegard here from the Prolific Investor, and he's going to give us some insights. We're going to have a bit of a discussion here talking about what kind of non-conventional or unconventional investments that are available. And I think this would be real interesting. So you guys definitely stay tuned to the end here. So welcome, Chris.
Thanks for having me on, John. Really appreciate it. This is going to be a lot of fun.
Yeah, I was fascinated when I saw your site. I like that you have, I think so many people are hung up on the traditional kind of conventional investments and they don't really consider anything else. And you've got quite a wide array of other investments. So so maybe you can start off by just talking about kind of what you do and kind of what your background is.
Yeah, so I was pretty much a conventional investor and corporate guy for most of my life, and it served me pretty well, put me in the middle class. But what I know now is that I left millions of dollars on the table by just being in the stock market, because there are so much better ways to make money. Around 2009, and some of your listeners might be able to relate to this, I had what I call an illiquidity event, and that's where you lose a whole bunch of money. Mine happened to be a divorce, where I lost 55% of my assets and thousands of dollars a month in cash flow for a period of time. And at around 44, 45 years old, I knew that if I was going to, not work until I died, I was going to have to do something different. And a colleague that I had worked with had given me a book, and it sat on my nightstand for longer than I care to admit. And that book was Rich Dad, Poor Dad by Robert Kiyosaki, which has changed millions of lives, and it changed mine. And I read that book, and it just had a call to action to me and an alternative investments, and that started off in real estate. So between 2009 and 2018, just 9 short years, I had made up all that money and multiplied it many times over, and that would not have been possible in the stock market. So on my website, theprolificinvestor.net, I have something called the hierarchy of investors, which is something that I created to kind of explain, what my mission is. So if you think, your listeners think back to when they were in school and they learned something about Maslow's hierarchy of needs, where you have, the physiological needs, food, water, and shelter on the first level, and then you gradually move up till you get to the top and you're in self-actualization. Oh, there's the picture. So if you look at the shadow of the pyramid down there in the lower right-hand corner, those are conventional investments, and conventional investments are everything that's publicly traded. So that's stocks, bonds, mutual funds, ETFs. It also includes, bank accounts and cash. So those are conventional investments. Everything else that's on the pyramid, which is the vast majority of the rest of the investing world, is what are called alternative investments. And I'm a little bit unusual in that I almost exclusively invest in alternative investments. Those things are things like notes. Notes is just another term for a mortgage. So, a bank might own the mortgage on your home. I could also own the mortgage on your home. Real estate, every kind of real estate, everything from single family, self-storage, apartments, commercial, shopping malls, precious metals, silver, gold, cryptocurrency, business equipment. I own ATM machines all over the country, never seen one of them. I get paid, regularly every month on those things. Private lending, I could lend you money or lend your business money. Energy, oil and gas, and believe it or not, very top, you got cash value, life insurance. There's some really good investing opportunities in the right type of cash value life insurance. So when you look at just that little slice down there at the bottom of conventional investments, which is where most people invest, if you went to a financial planner and he talked about building you a diversified portfolio of stocks, bonds, and mutual funds, you're really not diversified at all. You're diversified that's called paper. Those are paper assets, right? So you don't have any diversification. And then on the left side there of the pyramid, I have the advantages, one disadvantage, and a couple of neutral items. And the advantages are just overwhelming for alternatives, but we're not bombarded daily. We hear about Fidelity and Vanguard and all the people that want to take a little bit of your money to keep you in that mediocre land down there in the shadow of the pyramid, where the real money is made up on the pyramid. And you don't have to be rich to be there. You just got to have a little bit better financial education. So that I'm trying to pull people or push people, up that pyramid if I can. So.
Yeah, I love this chart. So you've even got the types of ownership, everything from people not even indicating the 401k or IRA, which you can invest in trusts, businesses, syndications. So
those are really the way investors typically own stuff. So when you start off, and you buy some stocks, you have a brokerage account that's in your name, and then later on, you'll have some stocks and things, and they'll be in the name of the 401k, and then someday somebody will say, well, you should really have a trust to make it easier to pass your assets on to your heirs when you die, and then you'll have a living trust. But professional investors like myself, we don't invest in our own name. We invest. Our business is investing. All my investing is done through an LLC or a corporation, and I get all the tax benefits that the Fortune 500 companies get, by investing as a business. When employees earn their income from their employer, they pay taxes on their gross income. You get $100,000 a year. The IRS takes their piece of it first. Then you pay all your expenses. You get to do this little reconciliation at the end of the year with the IRS, where you get these few measly deductions. When you're a business, you get your $100,000 in revenue. You subtract all your expenses, and then you pay taxes. That's what I do. I subtract all my expenses from the investment income before I pay any taxes. And anybody can do it.
Yeah, exactly. Yeah. So let's talk about a little bit about the, what to do now, right? I think that, that's the thing that I've been getting a lot of questions on, and, I'm in quite a few of these things in this pyramid here, but what do you think about now? Because, what we've been seeing going on is a massive printing of dollars by the Federal Reserve. I think, after that $2 trillion, now we're probably at like 70% of all dollars created have been created in the last 2 years. Right. Before it was at 40% before that. And now, it looks like we're going to have some kind of massive inflation, right? We're already seeing the indicators with the real estate interest rates going up and the 10-year treasury starting to have a higher yield. Yep. So where do people put money? I mean, I was looking at, I'm pretty invested in real estate. I've got some gold, I've got some crypto, but I'm a little gun shy to invest more in real estate because I feel like we're gonna, that's gonna come crashing down when interest rates come up. Right. And then stock market, of course, we have the worst economy in the last 50 years, yet it's going up.
The stock market doesn't know it.
So, where do you think? What's the way to preserve? I guess even just to preserve wealth. Forget about making money. If you just want to preserve the money you have, so you can buy real estate when it crashes. Yeah. What do you think about this?
Well, I have to make my disclaimer that I'm not a financial advisor, so I can't give financial advice. But I'm happy to tell you what I do and give you my opinions and some ideas and information. So, there's in every market cycle, there's a place to make money, right? So downside, upside, and you were talking about inflation. People are talking about inflation. There's at least one guy out there that's talking about deflation. So, nobody really knows where it's going to go. There are people that are talking about a major shift in real estate values because, but it's not nationwide. It's all kind of local. I'm out here in the suburbs of Seattle. People are leaving places like Seattle and Portland and Los Angeles and New York, and they're going to places like Arizona and Georgia and Florida and the South. So there's money to be made in real estate. I'm investing in real estate. I love apartment buildings, but not every apartment building is the same. Apartment buildings in specific markets and self-storage. And I'm also, I'm hedging my bets with some investments in gold and some investments in cryptocurrency because you just don't know. And, It seems like you could never go wrong with gold. I mean,
Yeah.
2,000 years ago, you could buy yourself a toga and a pair of sandals with an ounce of gold. Today, you could buy yourself a suit and a pair of shoes. So you could definitely, at least preserve your wealth there. So, I'm doing apartment buildings. I'm hedging my bets in places like gold and cryptocurrency. And, there's a certain type of cash value life insurance where you have to find the right insurance agent. So let's just say, and I don't even need life insurance for the death benefit. I buy it for the borrowing capability. So let's say I put $100,000 into a whole life-based life insurance policy.
Okay.
And 15% of that, or $15,000, went to the death benefit. So I'd have $85,000 left over that would be earning 4 to 6% tax-free interest, almost guaranteed. And these policies are almost bulletproof for creditors. But I could turn around the next day and probably borrow about 70 or 75% of that money out. Now, I'm not taking the money out, so the money is in the cash value. And then since the insurance company knows that their policies and their investments are rock solid, they'll turn around and loan me money. It's kind of like a HELOC. I've got $85,000 cash value here, and they'll turn me around and loan me most of that out the next day at about the same interest rate that I'm earning, but I'm earning compound interest and I'm only paying simple interest. And guess what? I never have to pay off that loan because that loan will be paid off by the death benefit when the insured dies. So all I do is once a year, I pay the interest on that loan. So, I'll take the money, I'll put it in the insurance policy, I'll make money here, I'll turn around and borrow it over here. I'll take the borrowed money and put it in an apartment building or ATM machines or gold or crypto, whatever. And I'm making money, I'm trying to do the camera here, in two places at the same time. And it's also, we saw in 2020 that most Americans and most businesses don't have any kind of cash reserves. Most people in businesses couldn't go 6 weeks without a paycheck or a customer, much less 6 months. And the insurance policy is a great place to just hold your reserves. It's in there, it's liquid, it's stable. You can borrow it out or pull out the cash value. So that's another place where I continue to put money. I really just cycle it through there. So.
Okay, so let me break that down. Let me see if I got this, because I haven't done this before, but it sounds like what you're saying is that if you put it in an insurance policy, like one of these whole life insurance policies, it's asset protection, first of all, because creditors can't touch it, just like they can't touch your 401k, right? And then you are doing an arbitrage because you are you're paying in interest, but you're able to make more money on that than what you're paying in interest. And you're just paying off the interest, the simple interest every year, which is a fixed amount. So you borrow $100,000, interest rate's 4%, it's $4,000. But you take that $100,000, you put it into an apartment complex, where you're putting 20% down or 25% down, so you have $400,000 apartment complex. That thing generates you, I don't know,
whatever, $10,000 whatever,
yeah. So you let's say $10,000 in a year. So you take the 4,000 from that 10,000, pay off the interest on the other, and you got 6,000 left over that is just free money.
Yeah. You're basically making money in two places at the same time.
Right.
The cash value is earning you money inside the policy, and you've got an interest-only loan basically for an eternity, and so you're using the money in two places at the same time. I mean, and pretty soon you can't even calculate the ROI anymore because you've got the money in the policy, you've got it in the apartment building, now you got it out of the apartment building, and you've got it into the next thing, and it's just a huge multiplier effect.
Okay, I've never done that, but that sounds because I've heard people talking about life, and it's hard when you talk to a life insurance salesperson. They
and
different ideas.
and a lot of people, sometimes financial products get a bad name that goes back decades, and it never kind of goes away. It's a little bit like whole life and reverse mortgages kind of got a bad name a long time ago. And all policies are not the same. One of the complaints about what I'm talking about is people would say, oh, well, but it's 5 years before you could ever get that cash value out. Well, if you get the wrong agent and the wrong policy, that's true. So, if your listeners are interested in this, I've got on the resources page, I've got a link to the place where I get my policies.
Oh, perfect.
And let's see, it's down there. Let me make sure
Money Insights, is that it?
Yes.
Okay.
Yeah, Money Insights, Cash Value Life Insurance. Yeah, that's the place.
All right, let me take a look at that here. Okay. And by the way, where we're looking on the resources, guys, is on the prolificinvestor.net. And so this Money Insights. So I'm definitely going to check this out myself here. That seems like a good plan. So, okay. So that makes sense. So, and then, we talked about, I guess, what are some of the things that you're investing in that are kind of on this pyramid? So like, I guess maybe we can, as a starting point, like I'll look at this pyramid and see where I'm at, and then see what it is. So I pretty much have nothing in stocks, bonds, mutual. I don't even think that's worth it. It's like, I know that like residential real estate, my whole thing is like, 5X lever. So if your appreciation is 3%, I make automatically 15% per year on any residential real estate I buy, not counting the cash flow.
Right.
So I've got a lot in residential real estate. Mm-hmm. I just bought a bunch of gold, mm-hmm. just in case, physical gold, right? I've got a bunch in crypto there. I've never touched the business equipment thing. That's interesting with the ATMs. How does that work? How do you get involved in that?
Yeah. So, this is, there's a couple of ways to do this, and I always pick the easy way, and the hard way is, you go out and buy some ATMs and you put them in your pickup truck and you drive around, you negotiate a lease, a little tiny lease with the 7-Eleven guy, and then you put cash in them. So these are through syndications where some of the, I just basically write a check and I have ownership by serial number of a certain number of ATM machines, and they're located all over the country, in markets that were picked by people that do nothing but manage ATM machines where there's high traffic.
Yeah.
And then, the people that are involved in the ATM is the ATM owner, which in this case would be me, the person that owned the real estate that it sits on, the convenience store, the shopping mall, whatever. And then the other one is, the person that manages this thing, fills it with cash and maintains it and makes sure it's running all the time. So then each of those parties get a little slice of those ATM fees. Now, if I had 6 different ATM machines at 6 different locations, I would get a different amount of revenue every month because it all depends on the number of transactions. But a particular company that I use, what they do is they pool all these things together, and instead of everybody getting a separate amount, we just get what's called a blended return. We just get a fixed payment every month. And I started doing this, and I want to say it was 2017. And so, every month since 17 or 18, all through COVID, fixed amount of cash flow coming out of these things. They get under a regular type of depreciation, they're depreciated over 5 years. So you're only getting taxed on, you're not getting taxed on 20% of the revenue for each of the first 5 years. After the Trump tax law, we got something called bonus depreciation.
Right.
So whether it would be an apartment building or even ATM, if I bought $100,000 worth of ATM machines in, let's just say, January of 2021, I would get $100,000 loss that year. Yeah. That means the first $100,000 that comes in of the right type of income, not W-2 income, but other passive income, no taxes, right? So that's one of the big deals about these alternative investments on the hierarchy is the ability to use leverage, right? When you buy single families or, when I buy apartment buildings, I can go to a bank and say, hey, can I borrow $80,000 for you to make $100,000? I'll put 20 in, you put in 80, and we get this long-term fixed rate debt. You can't go to your stockbroker go to your bank and say, hey, bank, I'd like to borrow $80,000 to buy my diversified portfolio of stocks and mutual funds. Not going to happen, right?
And see, I think that's the thing that so many people don't understand when I have the argument, because guys down here, they're like, it's a basic investment ETF, S&P 500 ETF, something like that. And they're like 8% returns, and I'm like, well, and they're like, but real estate only has cap rates of like 7% or 8%. So this is beating it, but this is an 8% return on your cash, but you can't leverage there. But in real estate, if I get a 7% cap rate, and I've only put 20% of my own money in, I'm making 7% on 80% of the bank's money on that property. That's a multiplier.
Yeah, I want to show you. Let me see if I can find this real quick. I want to take you to let me see here. One of my blogs, because I want to show you guys the math. This is where people, if I tell people the kind of returns I make, they either think I'm crazy or I'm a crook. Let me just see which one I'm going to look at here. Second favorite tax saving story. That's not the one. Hang on.
And while you're bringing that up, and correct me if I've got something wrong, I want to talk. I'll talk a little bit for everyone listening about what you're talking about with the ATM, because I think a lot of listeners aren't familiar with syndications, right? So first of all, probably have to be an accredited investor in order to do something like that. And so that means you need to have, make over 500,000 or
it's 200,000 a year in income as a single filer, and 300 jointly, or a net worth of $1 million,
right?
Without not including the home equity.
Yeah. Okay. So you'd have to be an accredited investor, but then these syndications, they're not just for real estate, right? Like this one is ATM syndications. So then there's going to be a managing partner, and then you're going to be a silent partner in that. And then they will take some kind of management fee out of that, but then you'll get distributions from the returns on it. And what kind of returns were you getting on these, or have you been historically getting on the ATMs? I'm curious about that one.
I'm looking at, if you look at blog number 6, if you go to the blog page.
Okay, let me switch over there. Okay.
Blog number 6 is titled My Favorite Tax Saving Story.
All right, let's go to blog. All right. I see number 6. Okay. Bless you. All right. Older. Yeah, I'm actually in the syndication right now. It's a SaaS. It's this company, or the syndication. They're buying SaaS applications. Actually, it's this. It's right here. I've got the hat. It's Sure Swift Investments, but SaaS companies. So they buy a bunch of SaaS companies, and then manage it all together, and it's actually turned out to be one of my better investments.
Yeah.
Okay.
So if you scroll down at the very top there, not right below the text, right above the diagram, you'll see that's a line. No, sorry, the next diagram down below. Sorry.
Oh, okay.
Yeah, see right above that diagram, you'll see a line from my tax return. See that negative $104,000? That's my business loss year in 2017. Well, that's a phantom loss. That's depreciation.
Right.
So, and then this is an internal rate of return calculator that I did on the web. And if you just go down there, you see the internal rate of return, including the tax benefits, was 35%.
Wow.
So, your guys that are talking about, the 8% in the stock market, I mean, how long is it going to take you to retire, or at least get to a place where I like to say where you can make work a choice instead of a necessity? When you're making 8%, that's before taxes and inflation, right? You're down in the low single digits, what you're really putting in your pocket.
Well, my favorite thing to have people do, I have it in my Bulldog Mindset membership. I have a lesson on this where I say that, everyone should do a compound interest calculator and play with this thing. Because because everyone thinks they're going to get rich someday, and then I'm like, well, that's not a good one. There's some that have some Nice. Oh yeah. So this is a good one. So it's like, okay, well, how much money are you put in? Are you going to save? So you have $100,000 to invest, and then how much time you got before you want to retire? Like 20 years, or that's additional. And then it's like, and what's the interest rate you're getting? Okay, 8%. Well, let's see if you're going to get rich.
Mm-hmm.
Oh, that's not rich, right?
Well,
so
like, put in 35% and see what it does.
Yeah, but see, yeah, in 20 years, if you get 35%, now we're talking. Let me zoom in on this. Now we're talking $40 million. Yeah. So, like, accepting an 8% interest rate, no. I mean, even if you can get a 15% interest rate, you're still going to be a millionaire, right? It's like, but you play with the compound interest calculator enough, and you start to realize you need two of the three things. You need either a lot of time and a high interest rate, or you need a lot of principal in a high interest rate, or a lot of principal and a lot of time, right? Any one of those things, you have, even if you get a low interest rate, but you have 100 years, you're going to be a millionaire. But
there's some studies. This was from, I got some studies here which are interesting. Well, this was from the balance. The average return on the S&P 500 over its total history is right just around 10%, a little bit short of 10%. But the average investor, for all kinds of reasons, when they get in and out of the market, emotional trading, they get just a little over 5%.
Right.
So now and that's before taxes and inflation. So like you said, you either really have to have a massive amount of money that you can earn at a low rate, or you got to have a whole bunch of time. And most of us don't want to have either one of those. We got limited time, we got limited resources, and it's not hard to do this stuff. And now that's admittedly easier to do it if you're an accredited investor, but there have been some rule changes. And now if you're like a certified financial planner, you can take those tests and you can fall into the accredited category. And what I've heard is that there's actually the regulations haven't been written yet, but you're going to be able to take a test and get a knowledge-based accredited investor stamp. And when that happens, that's just going to open this world up to a whole bunch of people. You got to put in the time and effort, but it's well worth it, right?
Oh yeah.
I didn't do anything more than, number one, pick a good syndicator, figure out who these guys are. And then number two, write a check. And in some cases, I borrowed some money with private loans. I got 3 or 4 people together, because this particular investment's $104,000 minimum for 6 machines. Yeah. So, you got to come up with some cash.
Well, we'll have to. I'm definitely, if that syndicate is still open, I'm interested in it. I'll deploy 100 into it.
Everybody loves this one.
Looking at, I mean, just what you said, right? That example of let's say, because again, because everyone makes an argument, oh, I'm just going to invest in the stock market. Okay, if you get your 10% return, which you're not going to get, which we're not even including taxes, and we're not looking at inflation, and you have $100,000 to start with, in 20 years, you're still not a millionaire. You're not even close to being a millionaire. You need probably like 35 years, I would guess. Yeah. Well, yeah, 35 years at 2.8 million. That's a long time. Right. And even if you're like, okay, 20 years and you're going to put in an extra like $20,000, a year, it's, now you could be, have $2 million in 20 years. But it's, but let's break down. I want to break this down a little bit just to understand how this, what you've got in here, so we can really see what this return is. So these are the amounts of the dividends that you're paid on your investment.
Yeah. So the initial investment, that's what went out the door, -104, right?
No.
And then every month I get a check for 7 years for $21.55 a month.
Okay, so you put in $104,000 of your own money.
Yep.
But you also got a write-off for $104,000,
right?
Because you depreciated the whole amount. So you essentially got a 35% rebate on this, or somewhere around that.
Well, right? Yeah, you could. I made like a 30% return the day I wrote that check, right?
Right, because you saved that amount in tax. You would have paid 30%, 35% on this $104,000 in taxes, but instead you didn't, because you were able to appreciate that immediately. So you save that tax money, which is like $30,000 right there. So 30%. And then you started getting returns on this money. And these are what, quarterly returns?
The $21.55 is monthly.
Oh, monthly. Okay. So you were making, what's the return on that? So just on the monthly returns without the depreciation, you're looking at Is that right?
You're looking at $181,000 over 7 years.
100 over okay, but over in a year on your 104, you were getting 21 like 20.
It's $25,800, something like that.
So you're making 25% on your 104, just straight cap rate without any kind of depreciation or anything.
Yep, correct.
That's crazy.
Now I'm looking at this. I'm not sure if this. Yeah. Okay. I was just trying to think if I had the. I'm pretty sure. Yeah, the taxes are in here. The 35% is with the tax in consideration.
Yeah, that's with the tax. Oh wait, this looks like every other month, the payments.
Well, regardless of what's on there,
it's still it's still a lot. It's still a lot. Even
no, the payments are every month.
Oh, I see. Okay, you just.
I'm not sure why. Okay. I'm not sure why they're.
I see. No, I was reading it wrong. It goes back and forth. Yeah. Okay, so it's every month. Yeah. So it's So you invest $100,000, you're getting back $26,000 in the first year.
Yeah. Right. That's crazy. and you're only paying taxes on 80%. So only paying taxes on 80% of that. So it's crazy.
Yeah, that's crazy. That's good. But yeah, I went into the ATM thing. Here's like some of this stuff, I call it secrets that are hidden right out there in the open. Right.
When you consider federal, state, city income, and sales tax and different fees, about 50% of people's income is going to taxes. And that is actually the lowest hanging fruit. The quickest way to increase your returns is to reduce your taxes, because every dollar taxes that you don't pay, that goes right into your pocket. And, setting up a business structure and becoming a professional investor, there's a book that everybody should read. This is also on the resources page. It's called Tax-Free Wealth by Tom Wheelwright. Yeah. And this will completely change your mind about taxes. One of the other, there you go. And then make sure you get the second edition. He updated it, so make sure you get the second edition.
I'm not seeing it here.
Oh no, you just passed it. Go back up. Right there's Tax-Free Wealth.
I see. Okay.
Yeah,
I see. It's Rich Dad now. They have the.
He's one of the Rich Dad advisors. So I figure if he's good enough for Robert Kiyosaki, he's good enough for me. Yeah,
I'm definitely gonna get this book. So and Repair Butler said this is fishy, which I understand him thinking that. But this investment that I have, the SaaS company, they're paying me about $2,000 a month right now. So far, I committed $250,000 to investment, but they've only taken 100 of my draws so far. So on my 100, I'm making around $2,000 a month. So this is legit, but it's accredited investor. I think that's the thing that people don't understand, is that these opportunities are not available, and there is risk. Like for example, on the ATM deal, what's the biggest risk that exists with that?
I think so these, and let's go back to conventional versus alternatives. The other thing you can't do with your stock portfolio is go to your insurance agent and say, hey, I'd like to protect my policy from some great losses. Well, you can with the ATM. So they're insured. So they could be stolen, they could catch on fire, but you have insurance. The other thing is that, something happens and that, all of a sudden that particular ATM machine isn't performing. Well, guess what you do? You pick it up and move it to a place that is performing. Right. I think the biggest thing that comes to mind is that people stop using cash and that they become obsolete over time because of different payment methods. But, along with, the PayPals and the Venmos and all these other ways that people pay, cash usage is on the rise, and ATM usage has gone through this whole COVID thing without a hiccup. So while that's one of the theoretical things that it's out there, it doesn't appear to be happening. So it's hard to say. And ATMs can be changed and modified to do things other than just take deposits and dispense cash. You can pay bills with them. So that's a risk. So you got to think about, okay, are these things still going to be viable? Because there's a 7-year life on these. At the end, they're 7 years, they're kind of old, and we sell them for whatever they're worth, and it's kind of like a used car.
Right. So that's what the other thing I was going to ask you about. So you've got this capital investment here, it's going towards buying ATMs, some towards the management fees of the syndication and overhead and stuff like that, locating them and stuff like that. But so you've got shares in the syndicate essentially that represent the asset value of that syndicate. So like after 7 years, if those ATMs are not worth any, or they're not functional, or not, they sell off those ATMs. That's so your capital is still deployed here, right? So you can't.
So these go to zero. So this investment goes to zero at the end of 7 years.
Okay, so you have to make that money at the end of the 7 years.
Well, now, yeah, if you invest 100 and you're going to get 181 back. And plus you're going to get the tax savings. Now, if you spend this is the difference between this and an apartment building, which is an appreciating asset. This is a depreciating asset. It's a piece of equipment. So if you spend all that money, it's gone. So, I mean, if you're looking for, think of this as a really high paying annuity, right? And it has this fixed term. So you just have to, you're going to make a good return, but if you spend all that money, it's gone. So, I just keep cycling money back, through insurance policies and into different things. But I want to correct one thing, which I think you said. I mean, this isn't a shareholder that you're accompanying. You own by serial number those things, and then there's management agreements that so that we don't have to touch these things. But you're the owner of those ATM machines, and so they'll get sold, and everybody will get their share, and then that's kind of that.
Okay, so then when we calculate, if we're to calculate, I mean, your IRR is based on you preserving your initial capital, but if your initial capital goes to zero at the end of 7 years, then this is going to be slightly less.
No, that's just the internal retained return over that, for getting that money over those 7 years. So it doesn't, when you run it out, you just have it's a cash in, or excuse me, a cash out and a cash in, and it's 7 years, and that's your rate of return. Now, what you do with that money, is up to you. You're still going to have $181,000 or 80 something thousand dollars more than you did when you started. You're going to get your 100 back plus an additional 80 something.
Oh, I see. Okay, because you're going to get 110 net that was paid out. Right? Because if we looked at like a compound interest calculator, right? You put in your 100, let's say, we'll just use even numbers, and you've got 7 years and your interest rate is 35%.
Yeah, so it's a different, because the internal rate of return, measures, the value of the cash flow, and it's not compounding, right?
Oh, I see. Yeah, it's not compounding. Okay, you're just getting 35% each year, essentially, on this one. Oh, okay, that makes sense. Because if we said 104, I'm just trying to make sure I understand this completely, times 0.35, you're getting $36,000 a year times 7 years, 254,000. So it doesn't quite come out to the, unless I'm missing something else here, but maybe because I don't have the tax savings in there.
Well, yeah, if you might want to find an internal rate of return calculator where you say, my outflow in year one is 104. Well, it's actually less than 104 because you put out 104, then you get 25,000 back, and then years 2 through 7, you get the 25, and that'll give you your internal rate of return. You also have to, figure in that you didn't put out $30,000 worth of taxes.
Right. So I guess one way to look at it is in 4 years, you've recovered your initial capital, and then everything from there on is profit. Yeah, not counting the taxes. I mean, if you count the taxes, then you're in 3 years, you're above breaking even.
And that's another, when you think about the risks, the other thing is, even though this investment runs for 7 years, at some point in time, you've gotten all your money back and you've, deployed that someplace else. And now, you're just getting what's left over, and you did earn a good return. So anyway.
Okay. Yeah. But, and it's also a liquid. I guess that's a big risk, is that like you put this money, there's no way, it's really hard to sell shares of a syndicate.
Yeah. If you go back to the hierarchy of investments, the one disadvantage there's 13 categories there. And the one disadvantage is is that these investments are not liquid. You put your money in an apartment building, or you put your money in the ATM. Now, I could sell you and I could enter into a private transaction where I would say, hey, I've got 5.5 years left, and we could agree on the value. You would give me a lump sum, and then I would just assign all the future payments to you. It would be, outside of the syndicator. But anyway, that top thing up there, the disadvantage of alternatives is they're not liquid. Your money is typically tied up in there.
Right.
But it's kind of the dual edge of sword of this is when things are liquid, they're volatile. That's what's in the stock market. When you can sell something like that, that's what drives prices like this. So, there's the real estate guys, I don't know if you listen to their podcast. I was listening to one of the guys talk one time, and he was talking about real estate, and he said, the only time there's only two times when the value of a real estate matters. It's when you're buying it and when you're selling it. If you bought a good piece of property that's cash flowing, you don't care about the value any other time. Nope. And if these ATMs were liquid and you could buy and sell them like you buy and sell stocks, this would be a terrible investment. People would have bailed out of this, and but instead $21.55 a month every month, all through COVID. So
yeah, no, and in fact, a great example of that is the 2008 crash. Right, I bought a fourplex for $425,000 the year before it crashed. Right,
yeah,
but I had a 30-year fixed mortgage, and my rents paid the mortgage plus some. I had cash flow. So, everyone was doing these pay option arm, things. And I was like, no, 30-year fixed. I want solid investment. Yep. The market crashes. All the other people in that complex are short selling their fourplexes for like $250,000, $225,000.
And there's the opportunity in the down market, right? If you're willing to do it, right?
And a couple of my friends are like, oh shit, are you scared? You just lost $200,000 in a year on your investment. You just bought this brand new fourplex. I'm like, my mortgage payment didn't change. My rents actually went up. And then, and now I can refinance for a lower interest rate. So I just made more money. I'm glad the market crashed. Like, I don't care what the market value is. And plus, I'm never going to sell it for my whole life. I'm just going to keep it the whole time, depreciate it down to zero, and then never have to pay those taxes back because I'm never going to sell it. If I do sell it, I'll 1031 exchange it, and then I'll still never pay those taxes.
Here's what you do: you have it free and clear. Then you pull all the equity out in form of a loan. You put it into the insurance policy, and earn your money, and then borrow it right back out again and go buy another one. Right? Now you're making money like at three places at the same time.
And the beauty of that too, I think that a lot of people understand, is like if you sell a property, you get that income. Uncle Sam wants his part because you're going to pay taxes, a taxable event. Mm-hmm. But if you borrow money, you can borrow as much money as you want. You never have to pay any taxes on borrowed money.
Yep. How much time we got? I can give you one other story if you want.
Yeah, we got at least like 20 minutes.
Okay, so I'm going back to my blog here. Let's find this would be blog number 29.
All right.
So this was around the time when people were talking about Trump and the fact that he paid $750 in taxes. Well, he was an underachiever. I paid no federal taxes in 2019. And it was from making, one of these investments that allowed me to offset a bunch of income. So just to demonstrate that I'm drinking my own Kool-Aid here, I wanted to get $100,000 out of a 401k because I know that I can get better tax treatment outside the 401k than I can inside.
I love it.
So I'm trying to get this out. But as soon as I take that $100,000 distribution, guess what? $100,000 in taxable income.
Plus the penalty, right?
No, because I'm old enough and I'm not with the company anymore where that money was. So there was no penalty, but I didn't want to pay the $100,000. So when you and all your listeners read Tax-Free Wealth, what Tom Wheelwright will say is, look, the tax code is just a series of incentives. 90% of the tax code is telling you how to pay less taxes because the government wants us to do certain things that it knows it can't do well, like build houses and apartment buildings and go drill for oil and find coal. So because that drives the economic engine of the country and keeps people from rioting in the streets because they have jobs, right? So there's a lot of incentives for energy investments. So I took the $100,000, generated $100,000 of additional taxable income, and then I invested in some coal distillation units. I invested $100,000 in coal distillation units. This gets the same kind of energy is one of the few investments that will offset ordinary income, W-2 income.
Oh, interesting.
Yeah.
Okay.
So not only did that I kind of overachieved. Not only did the $100,000 offset my 401k distribution, it offset all my other W-2 type income, and I had a negative adjusted gross income for 2019, and I actually got a refund. I paid zero. Wow. I paid less than no taxes in 2019, and I did an article which was specifically about that investment, which was probably the previous one, and I wasn't going to do the one about I paid no taxes because people get kind of pissed off and they think you're cheating and all I did was partner with the government and did what they wanted me to do to stimulate the economy. And anybody can do this. You got to read Tom Wheelwright's book and start getting a little bit better educated. And once again, I saved $30,000 the day, I earned $30,000 the day I wrote that check. And now that investment produces $9,000 something a quarter for the next 5 or 6 years.
Yeah.
So anyway.
No, that's awesome. I love it. So when you do the energy investment, you said that you depreciate it immediately.
Whole thing.
And it's W-2 income that
yeah.
Wow. So that's crazy.
Against any kind of income. And this is, the risky part of typical energy is you're going out and you're digging for coal or you're drilling for oil.
Right.
These are, very, a couple $1 million machines which take coal that's already in a pile, and it runs it through them and it heats them at very high temperatures and turns it into different petroleum products that are used in pharmaceutical and cosmetics manufacturing. So we don't have to go discover the coal. I mean, there's plenty of coal around. All we got to do is run this thing through, and we have long-term contracts with these companies that'll buy as much of this stuff as we can produce. So,
okay. Anyway. So there's a few things I want to hit on. I know the guys are wanting me. I want to hit on crypto. I want to hit on what guys can do when they don't have as much income to invest, right? Because we're talking kind of big game stuff. And I do want to talk a little bit about commercial real estate as well. So let's start off with the crypto, because a lot of guys have been asking about this, and I put it on the thumbnail. I don't want them to think I'm clickbaiting them. So I see, this is what I see. Let me get your take on this. I see a lot of young guys, all right, just going YOLO, investing it all in Bitcoin and Ethereum and saying, I'm going to get rich, and then proclaiming to the rest of the world that they're so smart. And again, I have a lot of money in Bitcoin. I do, but I don't like this because it's not an investment strategy, even if it goes up, right? I mean, what's your take on this whole thing? I mean, and on crypto in general.
So I think so. I think a certain amount of your portfolio needs to be in stuff it's a swing for the fences. It's the grand slam. You're trying to hit it. And I would say it should probably be less than 10% of your portfolio. Right. And so the little amount of investing that I do in the stock market is in some of these, I'm talking like $500 in shares in these little companies that are in CBD or in some kind of thing that's going to help us get through the pandemic or whatever it is. And so those I call them asymmetric risk return, where $500 could turn into 50,000 or $500,000 or whatever. And you want to make those, but I don't think I'm not going to put all of my portfolio in there. I'm going to put a little tiny bit of it in there. And, and you want to do a bunch of them. So I could make 100 of these small investments. Let's say Bitcoin and some of the cryptocurrency is some of those 100 investments, and 99 of them could fail and probably will. But the one that hits will take care of all the other losers, right? But you only want to put as much money in there as you need to be prepared to lose that money. You say, okay, if I'm going to invest $10,000 in this, and if I lose it, it's not going to affect my lifestyle. I'm not going to lose sleep over it. So I think people should do that. But they could be right and they could be wrong. But man, if you're wrong and that's all you did, you're going to be in trouble.
Yeah. I agree with that. I think I put about 10% of my, maybe a little bit less than 10% of my net worth in there. And at the time I put into Bitcoin and Ethereum, I was ready to lose it. But it was a long shot, but I figured, I'm here. I believe in the future of it, and so it's a solid shot. But it was a speculation versus
it is a speculation, yeah.
Right, yeah.
I mean, it's not, it's a little bit like the roulette wheel. It could go either way. I mean, I'm bullish on Bitcoin over the long term, and I think there's a lot of applications that are going to come out of blockchains are going to change things, but some of those are going to be winners and some of them are going to be losers. But I kind of think Bitcoin's here to stay. And, I mean, I've even bought some recently in the 50,000. Yeah. So that tells you what my belief is, Yeah,
no, absolutely. Yeah. I'm in full agreement with it. I get accused of hating on Bitcoin because I don't agree with taking all your money, especially when you're young and all you have is $20,000 and putting it all in Bitcoin, and that's your one ticket. You have no other plan for how you're going to get rich. Your plan is that Bitcoin needs to go to, $100,000, and that's it. And if it doesn't, well, then you're going to be working at McDonald's.
Wasn't there some old saying about putting all your eggs in one basket? As I recall.
So the other thing I want to talk about is, because we've been talking kind of high level stuff. Most of the people watching this, they're not accredited investors, not yet. So, I mean, obviously, I would encourage people to get to that point. Let's get to the point where you can do it. It's not as hard as you think. What should they do? How do they get to that point? I guess the typical viewer here, they're working a regular job. Maybe they're trying to start a side business. I help in Bulldog Mindset for guys to do that or coach them to do that. So they know that they want to do that. They've read Millionaire Fastlane, right? So they've got that idea. Maybe they're doing some real estate investment. How do they get to that point where their net worth is $1 million? What's the road that you would have them take today to get there quickly?
Yeah. So if I was a young guy, so first of all, you need to perform at your job, whether it's your job or your business. You want to maximize the amount of income you have, because it's only the income that's in excess of your expenses that you can invest, right? The more of that you have, the better. So you want to do that. And then, if I were to start all over, back in my 20s, knowing what I know now, I probably wouldn't have put a dime in a 401k. Yeah. It's a bad investment.
Thank you.
The Roth being one exception. There are some, but if you were in your 20s and you just started accumulating single family residence, it's the old Monopoly game. Little houses turn into hotels, and there are. And the last thing I want to do is be a landlord and go fix stuff and do all that. And if your listeners have got busy jobs, they don't want that either. Right. But across the country, there are a handful of what are called turnkey single-family housing providers. Yeah. So there's a guy down in one is in one guy's in two markets. I think it's Memphis and recently in Arkansas, and he has got a waiting list. So this guy buys and builds houses that are for rent. Yeah. He'll buy them. He'll put a tenant in them. He's got a property management company that specializes in managing them. You show up either with cash or with the bank loan, and this isn't even in your backyard. And you're gonna have to make the decisions about when things need to get fixed and whatever. But you will be so far ahead of the game than you were with a 401k.
Yes.
And I have an article on the blog that's where I do the math. I said, what's a better investment, a 401k or a single family rental? Single family rental kicks its ass all day long.
It does. Yes. Thank you.
And here I saw, and I can't do the math exactly, But I heard a guy do this. So let's say that and here's what people here's what the detractors will say. Well, you lose you don't get the company match, and then you don't get the tax benefit if you do the 401k.
Right.
Well, you get a better one with
Yeah.
the single family rental. You get the tax depreciation that goes for 30 years, not just the day that you make the deposit, number one. And number two, you get the company match as well. It's called somebody else paying the mortgage for the next 30 years. It's better, right?
Yeah.
It's so much better.
Yeah.
And if let's say you bought a single family rental and you put 20% down, and the property never appreciated and it never generated any positive cash flow. It was just neutral. At the end of 30 years, just because somebody else paid all the expenses on that house, your return would be something like 13% with no positive cash flow and no appreciation. That beats the stock market all day long, right?
Exactly.
And
Plus,
what if you bought one of those houses every couple years, right?
Right.
And I heard somebody else say, look, I could cuss on your show, right? Don't be a selfish bastard. Just don't buy a house for yourself. If you buy a house for yourself, the more houses you buy from other people, the wealthier you're going to get, right? Be generous.
No, I totally agree with you. This is one of the most controversial things that I tell people is to not put their money in 401k. In fact, me, myself, once I started investing in real estate, I took my money out of 401k. I took the 10% hit on it and paid the 30% tax rate and still ended up far ahead by buying a real estate deal. Yeah. So it's like the only exception to it I have is that I have a self-directed 401k right now. And I use that primarily because I want to have one asset where I have asset protection that no one can touch. And so I take some money, get the tax benefit from that. But my whole thing that I tell young guys is I'm like, if you're not rich by 65, 66, whatever it is, you fucked up. Like, like don't put your eggs in the long-term, if nothing works out basket in the 401k. Instead, like take all that money and try to invest it now to make as much money as possible. So by the time you reach the age where you can take your money out of your 401k, it's you don't even care about that money. It's chump change. So. And
when you think about this, let's say you got somebody they don't like real estate. I don't want to do that. I like the mutual funds. I'm going to invest in my 401k. Well, so buy your mutual funds in your stock portfolio, but don't buy them in the 401k.
Right.
Because when you pull that, you defer that taxes down the future. And when you pull that money out, it's going to be taxed at W-2 level, the highest level. If you had put that money in a Vanguard account and did it, you're going to be paying 15% long-term capital gain. So you're killing yourself by putting your money in there. Either way you do it. You just
Plus, with the real estate purchase, you never have to pay taxes if you don't want to pay taxes. You could just keep on rolling it with the 1031 exchange, unless that gets taken away from us. But or you could just hold the property forever.
Right. You hold it forever, and you pass it on to your heirs, and their basis is what you gave it to them, and then it's tax free to them, right? So
So okay, so so I'm glad you said that, because I like it, because again, people always say, well, company match and all this, and it's still that when you do the actual math, it works out that real estate is a better investment.
It is, yeah. It is.
So okay, commercial real estate. I wanted to get your take on this. I recently, about 2 years ago, maybe about a year and a half ago, I bought like a $1.2 million commercial property cash because I 1031 exchanged like 6 of my rental properties. Now I got a triple net lease on this. It's beautiful. It's my best investment ever because I get like a 7.25% return and I do nothing. I literally do nothing. I just collect the check. I love it. You know what I mean? I just send them an invoice. I don't have to have a property management company. I don't have to deal with fixing anything or maintenance, repairs. I see you have it really high up on the, that's why I'm asking this. You have it really high up on the pyramid here. Is that why? Why do you have it so high up there?
The pyramids those kind of represent kind of the things that I did kind of in the order that I did them. And I thought that might be, just starting small and moving up big. So I'm kind of really locked into apartment buildings because there's no technology out there that on the horizon that's going to eliminate the place for people to, have a roof over their head. With the commercial stuff, I mean, it's more subject to economic things, and COVID comes, so people stop going to the mall or whatever. So I haven't done it, but I am intrigued with the triple net leases. And there's a guy his name is Michael Flight. And if you like the triple net, that's what he does. He does shopping centers and commercial stuff and triple net. And he's got the first, and he's michaelflight.com. He's the CEO of a company, and they've got the first, I think, triple net fund that is where the ownership is via blockchain. So there's a token. So there's a token.
Nice.
But I mean, if I were, and I may go down that path someday. And if I were to do it, I would give Michael a call and find out, what he's got. But he's bullish on this, and he's been doing this for 20 years or more, and is still doing it. So just something I haven't moved into yet, but I'm not opposed to it. I'm just a little bit more comfortable where I am. So.
Okay. Yeah, what I did with my commercial property too is just this last year I had a what's it called? A study. I forget what they call it now. Basically, they figure out your depreciation on break it into the different assets, right? Because different assets when the commercial property appreciate at a different rate. So they try to move as much as possible, classify as much stuff as possible into the faster, the 5-year depreciation tenure, and then use the bonus depreciation, the Trump incentive. And so I got a huge depreciation on that property, which offset all the taxes. So it was a bonus deal on there. So.
Yeah, it's called a cost segregation. When they take a property and they say, okay, the structure of the building is 30 years, the air conditioning equipment is 5, the landscape, whatever, and so you get all these different elements depreciate. Of course, the faster, that means you get your money back quicker. So yeah, that's good stuff. Hey, let me add one thing. So for your listeners, because you were talking about the big dollar amounts and the people that aren't accredited. I have kind of a loose list of these turnkey single family rental providers. So if anybody is interested in that, let me know and I'll compile a list and I'll get it to you, and you could get it out to them, because I haven't used one, but if I were starting all over, I would do that. Or if I was partnering with a non-accredited investor, we want to do that, I would do that. And there's also something called the Fourplex Investment Group, FIG. And these guys build brand new fourplex neighborhoods that are meant to be rentals, and they've got homeowners and everything. So they keep these neighborhoods nice, and you don't have to be accredited to do that either. So those are the two areas where I would be looking at if I was in that situation.
Yeah, if you don't mind sending me that information after. And guys, make sure while we're here, go to theprolificinvestor.net and subscribe to his email list there. I see you've also got a YouTube channel.
Yeah, there's a couple things on there. There's a little quiz. You can take the conventional wisdom quiz, and it's a 10-question thing. And I designed it so you'll probably purposely get some of them wrong, and then the answers will link you to some articles on it. And you can also schedule a free 30-minute consultation with me. And then beyond that, I've got an alternative investor mentoring program where if you want to make the switch or move some of your stuff over or start investing in alternatives, I've kind of looked back at what I did over the past 10 years and put it in kind of a chronological order that'll help you get there more efficiently and make less mistakes. So 3 things that they could check out. Of course, there's the resources and downloads and all kinds of stuff there.
Awesome. I love that you have The Richest Man in Babylon on there. It's such a good book.
Timeless.
So, okay. I was trying to think. I was going to ask one more thing. So I was going to ask about the syndication. There was one more thing I was going to talk about the real estate. Oh, I know what I was going to ask you. So you're doing apartment buildings mostly for the commercial, right?
Mm-hmm. Yeah.
So are you buying things that are big enough? So I've been buying like fourplexes, duplexes, stuff like that for residential. Aside from the bigger commercial, I've got a few office spaces, but I wanted to get into apartments. Yep. And this is what I'm thinking. I want to run this one by you. Is that with duplexes, with single families, all that stuff, I have to hire a management company, and the property management companies they always end up turning bad because it's a conflict of interest. They want to make money off of maintenance. They have in-house maintenance. They end up, you have to watch them, right? So, and they're not working for me. I'm their customer. So I can't really, I can tell them what to do. I can fire them, whatever. Yeah. But my interest in buying an apartment complex would be, if I have an apartment complex, then I can hire someone if it's big enough that they work for me. They're my employee, their leasing agent or their maintenance person. Is there a big advantage there? Is that a big enough leap that it's worth going up to something like a $5 million, $6 million apartment building? Do you find that advantage there, or do you still use management companies with your property, with your apartments?
So I'm a syndication guy. So I'm typically a limited partner in an apartment syndication. Okay. So I'm basically, I was looking at doing so I started off doing some single family and some duplexes and fourplexes, and I ran into the same problem with you, the property management. So through my network, I've talked with, enough apartment investors. I said, okay, what scale do I need to be at where I'm gonna have the attention of a property manager? And the answer was like, you kind of be at 70 to 100 units before you're gonna be there. And so it's like, okay, that means I need to, pick a market and ramp myself up. But kind of what I've learned that works for me over time is, these apartment syndications that I'm in, we're making a 20 or 30% annual return.
Are you?
And I'm like,
really?
What?
Wow. Okay.
I don't think, I'm putting my money with people who are professionals at acquisition, at management, and let's say if I did it myself, I could squeak out a couple more percentage points, which I don't even think is possible. I think I would do way worse, right? I don't want to do it, right? It's not how I want to spend my time. I'd rather be on podcasts. Oh, didn't get to mention, I've got a book coming out this year. It's called Get Off Your Ass and Manage Your Money, Why You Need Alternative Investments. And on the homepage, there's a little green star there. So if somebody wants to get a pre-order, you got to go to the homepage, click on home or the. Yeah, there's a little star right there. Okay. So anyway, I got to get that one in. Cool. But anyway, I'm just a limited partner in these things. So
I'm not gonna put my email in there for everyone to watch, but I'm definitely gonna sign up for that. So okay, so so that makes sense. So I'm surprised 20-30% return. Yeah, I'm gonna have to look at. And you've got some resources for. See, this is another question. We're going a little over time, but I think this one a lot of people have as well, which is that with syndications, right? Especially apartment syndications, man, how do you vet because I guess that's a big risk, right? Because I did one real estate syndication. This guy, oh my gosh, it was not. I haven't lost my money, but it is not. I haven't seen any capital returns yet, and it's kind of ticking me off. So how do you vet these to make sure? Because, with a lot of these syndications, when you go and you read the whole prospectus, it's like, hey, management fee here, loan origination fee. They've got a lot of they're making money no matter what, even if their investment doesn't perform. How do you vet that out to make sure that it's not just, one of these things where you're gonna put your money in, the management is gonna make all the money and they don't really care about you? Yeah.
So this is I talk about this in the book. So this is, conventional investments feel like because, everything on the public market has been run through the SEC and vetted, that it's all safe. There are criminals in that part too. Now, in the alternative investment world, the reason they have accredited investors is because it's kind of unregulated and it's probably easier to defraud people. So that's the risk. And I always say, if I'm going to invest in Campbell's Soup, I can't call up the CEO and have lunch with him and find out how this company's doing. If I'm going to invest in one of these syndications, I can meet these people, have lunch with them. So I would say you get to personally know, like, and trust these people. And, you need to get a referral where somebody comes to you or you ask somebody, they say, oh yeah, I put my investments with these guys. So the syndicator that comes to you that doesn't go through somebody that you already know, like, and trust and respect, who has some good experience, he never even gets through the door. Right. So, there are different, there are different investing groups. I belong to the Wealth Formula Network, and a lot of my syndications and things come through there. and a couple other groups which I'm getting involved in. But it's like when I did the ATMs, I heard the guy's name is Dave Zook from the Real Asset Investor. I heard him on a podcast, and I thought this is really interesting, and I called the number, and he picked up the phone.
Yeah.
Wow. Yeah. So the advantage is you can get to know these people personally, but make sure that they're coming from a known trusted source. So and what you said about the syndicator making money where you do or not, that's something that you need to look at. How are the general partners making money?
Right.
So in this particular apartment syndication that I do, obviously the people that are employed by the company have to get paid and make money, but the general partners don't get paid until I get all my principal back.
Oh, okay.
So I got $100,000 in an apartment syndication, and what they're doing is a value add, and they're on a speed model to add the washers and dryers and to upgrade the suites, to drive up the value of the building, to refinance. And it's not until I get my $100,000 that they start getting their share of the profit. So I call what's having, the investor and the management company be in alignment,
Yeah.
So they don't make money unless I make money, at least until I get all my money back, So that's something to really look at is, what's that waterfall kind of thing, how they get paid. It's the thing I don't like about the conventional investments of the assets under management, where they're taking a percent of your portfolio, even when their advice is causing you to lose money. That doesn't happen in the apartment syndications that I'm in. So.
Right. Okay. Yeah. I'd be curious if you've got some resources for those, because it's always hard to find. So
there is, they're on, I think I got a couple. Western Wealth is the big apartment syndicator that I'm really kind of wedded to right now. Western Wealth Capital.
Okay, I think I saw that on your resources. I'll take a look at that. I was looking at some what are they called? Not CDDs. They're Delaware. There are syndications where you can roll 401 or 1031 exchange money into it. It's
Delaware Statutory Trust, DST.
Yeah, DSTs. Yeah. I was looking at some of those. The returns aren't so great on those, but
yeah, they're not. It's I looked at them, and that was my problem. I feel like it might be the kind of thing where you're kind of getting on the the latter part of the back nine of the golf game. You're 75, 80 years old. I just want to put my money someplace and get this nice steady dividend check, and it's solid, and you don't need the great returns, and it's hassle free. It's not for me right now. And you can avoid those 1031s by doing an ATM investment with bonus depreciation. That'll do the same thing. You don't have to, because you'll get that bonus depreciation. That'll offset all the capital gains from, a property you sell.
Yeah, I guess that's true. I mean, it'll offset it for then, but then you won't be getting the depreciation later that you would from it. So the characteristic of the investment changes. But essentially that's, you need something to use that depreciation against. So yeah, that makes sense. So. Okay, and then at the very top of the pyramid, you had the whole the syndicate, or become a syndicator.
Yeah, become a syndicator. I mean, that's you want to be, if you want to be on the general partner side and get some of that slice as well as the limited partner side. That's something. I thought it was something I was going to want to do. The real estate guys put on a Secrets of Syndication seminar 2 times a year, and I went to it, and it's really interesting, but it just sounds like a lot of work to me. So.
Yeah. That's what I was thinking is I'm looking at potentially doing one, and then I've got a big audience. So, and I coach a lot of people. So I would have a lot of potential. I'd be the guy that brings in I don't want to deal with all the other stuff, but I'll bring you in that'd be my part of the deal. So
yeah, you can be the guy who brings in investors for somebody else's syndication, right? I mean, if they can go think if you're trying to raise $20 million for an apartment building and you got to go to all these places, what if they could go to John and John could raise 10 of the 20 or even 5? They go, I know a guy who got brought in on the general partner side just because he had an audience that could bring a ton of money to the deal, with one-stop shopping.
Exactly. Yeah. Well, Chris, it's been awesome, man. We could talk for hours. We'll definitely have to have you back on the channel, and definitely going to get your book And yeah, I'd like to talk some more too about some investments, maybe share some investment ideas and stuff. So.
Sure. Yeah, I'll let you know when the book's out, and we can do it again. And you know, there's a couple ways your listeners can reach out to me. For free. I don't have unlimited time, but we'll book up some virtual coffees if some people want to talk to me and stuff like that. So.
Yeah. Tell them what's the best place to find you. What should they do next if they've listened to this?
Yeah, I would get. There's a 3-step thing. Take that conventional wisdom quiz, book a virtual coffee with me, and then take a look at the alternative investment mentoring program. And that is the only one of the 3 that costs you anything. So, yeah, take the quiz, awesome. Have a conversation with me, and we'll see what you're doing, and maybe I can give you some ideas.
Sounds good. All right, Chris, thanks again.
Take care, guys. For having me on. It was a blast. Take care.
Yeah.